Hi guys. Today we will analyze Huntington Ingalls stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. Both the short-term and long-term trends are neutral. Nothing spectacular is happening here. There should be more interesting stocks out there. Strong support levels are around $206 and $198. Next strong support level is around $178, $160 and $140. Strong resistance level is around $213. Next resistance level is around $222. In the last month the stock has been trading between $194.30 and $225 range, which is wide. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 0.3 million. This is not a very liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth. Even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 6% per year, for last 5 years. We see that the average profit margin of the stock has been around 7% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 79% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Huntington Ingalls Company: bad, average, and good. First scenario. Huntington will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 2%. Future profit margin would be a low, 6%. Future free cash flow to net income rate would be a low, 60%. In this case, the fair value of the stock today would be $161. Second scenario. Huntington will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 4%. Future profit margin would be average, 6.5%. Future free cash flow to net income rate would be average, 70%. In this case, the fair value of the stock today would be $219. Third scenario. Huntington will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 7%. Future free cash flow to net income rate would be high, 80%. In this case, the fair value of the stock today would be $289. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 13.33. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Huntington Ingalls, analysts forecast growth rate around 6% per year in next 5 years, and future P/E around 14. Again, I will use 3 different scenarios for Huntington Company: bad, average, and good. First scenario. Huntington will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 2%. Future P/E would be a low, 12. In this case, the fair value of the stock today would be $81. Second scenario. Huntington will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 4%. Future PE would be average, 15. In this case, the fair value of the stock today would be $121. Third scenario. Huntington will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 18. In this case, the fair value of the stock today would be $172. As you can see, today the stock is overvalued, $210, even if we expect the company's high performance in future. While the company has a good profitability rating, there are some concerns on its financial health. Also, the stock is expected to show a small growth, 6%, in the next 5 years. Based on that, the stock looks overpriced at the moment. I may consider buying the stock for the dividend, when the stock drops below $170. Company strengths. Huntington Ingalls Industries is the largest military shipbuilding company in the U.S., as well as a provider of professional services to partners in government and industry. It was formed in 2011, as a spin-off of Northrop Grumman. Huntington Ingalls has one of the most stable business models, as a prime producer of Navy ships. Its main customers are the U.S. Navy and Coast Guard. The Navy has proven a reliable long-term growth customer. Navy demand for subs, carriers, and other ships remains robust. Ships, unlike aircraft or ground-based products, often take 4 to 5 years to produce a single product, so the customer can easily reduce funding for a product, once production has begun. The current global geopolitical environment requires higher, and more targeted defense spending. Growing bipartisan support for U.S. naval superiority in the wake of Russia's invasion of Ukraine, leading to strong backlog growth in 2022 and 2023. Defense prime contractors operate in an acyclical business, and shipbuilders are particularly acyclical, which could offer some protection as the U.S. is currently in a recession. The company's return on equity of 19%, return on assets of 5% and profit margin of 5.5% are amongst the best returns of the industry. Risks. The major risks are political risk relating to the defense spending, and the risk that the customer's needs shift away from the firm's products. The stock is only an average performer, due to slow free cash flow growth, and ongoing supply chain issues and inflation. Labor and material shortages have slowed the company's production rates. A poor operating margin outlook for the company, due to its long-term fixed-price contracts, 53% of sales, amid high inflation. The company failing to accurately estimate costs and time for shipbuilding, which is increasingly difficult, as modern warships grow more complex. The U.S. has enacted substantial fiscal stimulus in response to the COVID-19, which may depress future defense spending. The company used capital to acquire Allian, a defense services company, which is outside the firm's sphere of competence. Huntington does not have exposure to international customers. This reliance on U.S. spending increases customer concentration risk. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 6% on average per year. The earnings per share is expected to grow by 10 to 15% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.